Yeah, today we'll run through the industrials supergroup sector. This is just a really quick snapshot of the industrial stocks that Liam, Nathan, James and I cover. And obviously we'll go into a little bit more detail on a few of these stocks a bit later, but just grouping them into our individual coverage universes. And this is just the stocks with a bit more detail and the key metrics such as trading multiples and recommendations, etc. And you can see from the table that the industrial sector is quite broad. It ranges from packaging and logistics to construction and engineering, as well as chemicals and a few others as well. Okay, this provides a snapshot of the best and worst performers in the industrials supergroup universe. The second column there is the 1 year total return, with Veeam, Acro, and Mars Group being the best performers, while at the other end of the spectrum, Adrad, DGL, and PPE were the worst performers over the past 12 months. If I draw your attention to the last column, which is the 1 year forward PE ratios, Reece and PWH are the most expensive stocks that we cover. They are also two of the high quality businesses in our coverage universe, while the cheaper stocks that we cover are Acro and Adrad. And interestingly, with Acro, despite being one of the best performers over the past 12 months, it is still one of the cheapest stocks in our coverage universe. And I'll talk to Acro on next. Okay, because just going straight into the key results to watch in my coverage universe, I've got two, which are Acro and Veeam. Understand that these stocks are not for everyone, given that they're both at the smaller end of the market cap spectrum, but nonetheless, I do think they're pretty good opportunities if you are looking to go down towards the smaller end of the market. On Acro, I'm expecting earnings momentum to remain strong following 4 earnings upgrades in FY23. If you look at secured high contracts, which is a key leading indicator of future performance, secured high contracts for Acro is up 35%. So I expect FY24 to be another good year. Longer term, the outlook for infrastructure investment remains strong and could potentially remain strong until the Brisbane Olympics in 2032. The stock has had a really good run over the past 12 months, up almost 60%. But despite that rally, Acro is still trading on about 8 times FY25 PE and a yield of 5.5%. And as I said before, remains one of the cheapest stocks in our industrials coverage universe. So I think the valuation remains attractive. And given Acro's recent history, I wouldn't be surprised if there was an upgrade to that for FY24 earnings guidance when they report in a few weeks' time. So still very comfortable with the ad rating on Acro. Veeam, haven't spoken on Veeam for a while, and I can understand why. I guess that the company has been in the sin bin for the last couple of years. If we go back to September 21, Veeam did do a capital raising and a sell down. However, that was followed up by a downgrade only a few months later. So it wasn't a great look, and can understand why I guess people have put the stock in the sin bin. But roll forward 2 and a bit years, I think Veeam is definitely worth another look following some really significant announcements over the past few months. So the first announcement was in October in relation to its propeller business, where Veeam has signed an exclusive agreement with Sharrow Marine. So for those who don't know, the Sharrow propeller was selected as one of Time Magazine's best inventions of 2023, due to it being 80% quieter and up to 30% more efficient than standard propellers. Veeam has an exclusive agreement to sell Sharrow propellers for the inboard motor market, with the price of these propellers at least 2 times the price of a current Veeam propeller. Veeam has to pay a royalty fee to Sharrow in order to be able to sell these propellers. But even if you take this into consideration, the margins that are expected on the Sharrow propellers are going to be higher than what Veeam currently generates from its propeller range. So hence the deal, I think, does have the potential to significantly boost Veeam's earnings over the longer term. The second key announcement was in November, and that's in relation to gyros, where Veeam, one of Veeam's key customers, which is Strategic Marine, Strategic has increased their orders from gyros to 12 gyros per annum. And that increase will provide a nice baseline for gyro sales going forward. And then roll forward, I guess a few weeks after that announcement of gyros, Veeam did provide a trading update at its AGM and did give guidance for the first half, and that guidance was well above our expectations. So I think earnings momentum for Veeam is definitely strong, and I expect the company to report a good result in a few weeks' time. So that's Acro and Veeam. The other stock I wanted to mention is Amcor. It's not one that I flagged as a key result to watch, but it is one that I thought I'd just have a brief chat about, given that it is widely held by the network. So I think, given where the stock is trading, I do think expectations are not high, and it is possible that even an in-line result from Amcor could see a re-rating in the share price. So a few key points to note. Firstly, first half 24 earnings will be weak. So our management has guided to EPS to be down mid-teens. So that's due to lower volumes from destocking, the sale of its Russian operations, as well as higher interest expense. However, if we move to the second half, Amcor will start cycling the destocking from last year, as well as the sale of its Russian operations. Management is implementing a cost-out program, and historically, Amcor has been very good at cost-out. So as we get into the second half, more of these benefits will start flowing through. And overall guidance for the second half is for EPS to be up mid-single digits. So just to repeat that, first half EPS is expected to be down mid-teens, and second half EPS is expected to be up mid-single digits. So that the first half should be the low point of earnings for Amcor. I think one of the interesting things with this is that I did upgrade Amcor to an ad back in November, and I did do a bit of a call around to instos, and the instos that I did speak to were really interested in the story. And I guess one of the things that they did flag or point out was that they didn't really believe that Amcor could generate that mid-single digit growth in the second half. But when I think about the building blocks that how they can get there, I think it's definitely possible. So we'll see how it goes. The stock's currently trading on only 13 times FY25 PE, yield of about 5%. So it's definitely not expensive. And I think the fact that a lot of people, I guess, aren't looking at it or aren't too interested, I think does make it an interesting opportunity. So one to keep an eye on. And with that, I'll pass to Liam to go through his coverage universe.
As we can see across my coverage, the larger cap stocks have really outperformed over the last year and even the last 3 months. And as I look across my target prices, it's leaving fairly slim pickings. So that inevitably leads me to look further down my market cap schedule. And I come up with 2 names. So the first one I wanted to talk about is Vulcan Steel. So Vulcan is a steel distribution business. Now, look, this is not going to be a great result for Vulcan. FY24 earnings have halved on 22. But, what we do know is that steel production and steel distribution is an extraordinarily cyclical business. This is a business that's focused in Australia and New Zealand. And, whilst business confidence in Australia is fairly lackluster, the turnaround in New Zealand is pretty surprising. And you can see there from the ANZ Business Survey really starting to turn around there after they formed government in late November. So look, I think this is one to look at. BlueScope, it's up 22% in the last 3 months, whereas Vulcan really hasn't moved. I think that by FY26, this business can be doing north of 200 million of EBIT and trading on sub 10 times. Now, if you've had the opportunity to meet management, look, they are excellent at what they do, and they acknowledge that they're in a very cyclical business. But, this is a story about buying cyclical businesses on low earnings and, preferably low multiples when you can. And that's why I think this will be a result to watch. The next one is DGL. Look, this is a really forgotten stock. No one really wants to talk about it. The buy side viscerally hate it. But I think it's something to just, pique our interest a little bit. I think that this business can grow strong, single digit organically. And then, with no divvy, 80 to 90% free cash flow conversion, acquisitions are going to play a role in its growth, but you've got sort of low to mid double digit returns for less than 10 times. This is set against the agricultural peers that have re-rated over the last 3 months, whereas DGL hasn't really got a bid. What the industry has suffered from is the chemical pricing, which has been volatile. It's come off, but these guys don't need a high price. What they are is they're a chemical toller. They just need stability. And it's, when prices are going up, they ride that escalator up, and the reverse is true when prices are going down. So, they benefit from a stable environment. And I think this is one to watch. And on that note, I'll pass over to Nathan.
Thank you very much, Liam. Yeah, I want to pitch you a downside risk stock being Cleanaway. So look, make no qualms about it. I think Cleanaway is a well-managed waste management company. It's got leading positions in each of the different segments that it operates. But I'm a believer that stocks move on the unexpected and not the expected. So if we look at what is out there already, the company has given guidance for FY24 for EBIT, it's 16% growth. It's solid, but it's known. They tell us what the D&A is going to be. That means we can work out what the EBITDA is going to be. They tell us what the net interest costs are going to move by. Effectively, they've kind of laid out most of the P&L for us. They also have these FY26 aspirations, and it's pretty strong growth, right? I mean, they're targeting sort of 425 to 500 mil of EBIT versus 300 mil in FY23. So you're sort of looking at 12 to 18% CAGR. Consensus is kind of in the middle of that pack, but it's known. They've told us what the CapEx is that goes along with that, both maintenance and growth. It's known. So we've already talked about the interest costs, but they've also got these LTI, these management LTI targets for FY26, and they're all supposed to be broadly consistent, the return on invested capital and also the earnings growth numbers. So I do some pretty in-depth modelling, and I could not get to where the return on invested capital number was. I was coming in way too high, and I put the question to the company. And digging on through it, it comes out that that they are going to be really increasing their spend on landfill remediation and rectification costs. So that's been tracking at about $20 million a year, and the expectation is that's going to be going up to about $100 million in FY24, and kind of half of that for the following couple of years. Now, that doesn't sit within those EBIT guidance numbers. That is something that will slide through the operating cash flow line. So I'm about high single digit less than where consensus is. So I think that will come as a bit of a rude shock to the market. We are used to seeing this remediation number being quite low. So stocks at $2.60 odd at the moment. I'm at $2.40 for the target. I just think it's one worth calling out. I'm not sure that necessarily will come through in this half. It's something that could build up through the year, but certainly downside risk for the stock. And now we're passing down to James, isn't it, for the next one?
Thanks, Nathan. The one stock that I've called out into this reporting season as being a key one to watch with some positive upside potential is Johns Lyng Group. So over the holiday period, we've seen 2 cat events declared by the Insurance Council of Australia, which occurred across Queensland and the East Coast states. These were ex-tropical cyclone Jasper and the Christmas storms, which saw significant flooding and storm damage. This has resulted in around 79,000 insurance claims just in December relating to these events alone, representing about $740 million of lost damage. In dollar terms, we estimate around 60 to 70% of these claims are property related. And will likely need attention for repair and restoration work, which should feed into Johns Lyng's work in hand into the second half of this financial year and potentially into FY25. In our view, this is additive to Johns Lyng's CAT guidance for this year, as we see this component of guidance only reflecting the work in hand in any given period. So coming into this year, their guidance is for about $137 million in revenue just off CAT. And we see some upside potential to consensus revenue for this component of revenue, with consensus having a 40% weighting to the second half. And because these events happened towards the end of the first half, we obviously see a bit of upside there. Additionally, we note that we'll be keeping a close eye on Johns Lyng's US progress coming into this result, which I think has taken a bit more time to progress than some investors may have liked. In August, management alluded to the fact that they've been working on leveraging their relationships in the US market and also with Australian insurers with a US presence to potentially land offtake work or a panel position in the US. We see this as a key component of the growth pathway in the US market. So, the company's sort of been quiet. We haven't seen any announcements on this front towards the tail end of last year. So any news on this front, I think, in my view, will be positively received by the market. Finally, we'll note that Johns Lyng, since its IPO, has had a positive track record of guidance updates at its first half results. We sort of track this in our tear sheet in our notes. Whilst I'm not saying that's a bankable stat, I think it is supportive of our view that this will be a result to watch coming into the first half. So with that, I'll hand back to Alex.
Thanks, James. I'm just going to put it all together and just summarise quickly the key results to watch in the industrial space heading into reporting season. Acro momentum remains strong with a positive outlook, and despite the run-up in the share price, the valuation does remain attractive. Veeam, I think worth another look with some significant announcements over the past few months expected to drive strong earnings growth over the next few years. Vulcan Steel, we expect FY24 to be the low point of earnings with a strong rebound thereafter on the back of better manufacturing activity. DGL, with broadacre conditions incrementally better than feared, we are relatively confident in our FY24 forecast. And then finally, JLG, we see potential upside to the company's CAT-related earnings guidance in the second half of FY24 and expect to see some progress in the US as JLG has been looking to firm up its insurer relationships in the market. So, that's a wrap from us.